Bank of America says today's 10-year Treasury rate is an attractive level to buy. They expect inflation to peak this quarter and to fall steadily into 2023. Joining us now is Meghan Swiber, Bank of America U.S. rate strategist. Meghan, thank you so much for joining us and for sticking with us. Let me ask you about this call in a bit more detail on what it's based on. Is this a very long-term view about where 10-year yields should be, or is this more short-term tactical?
Yes, so we recently recommended going long the 10-year Treasury rate. And there's three really core reasons why we like this trade. First of all, levels are really currently quite far from fundamentals. We think fundamentals are probably driven by really two key things here. The first is longer-term inflation expectations. The second is where longer-term potential growth can be. So really from that first core question, right, are we thinking this is short-term versus longer-term? Right now, levels have really just become dislocated from where we think those longer-term levels really should necessarily be, probably something closer to 2.5%, for example. The second really core reason here is because we're already seeing signs of a growth slowdown in the U.S. We're seeing signs that consumer and business confidence indicators are beginning to cool, and we're also seeing increased discussion of recession probabilities. The third and very important consideration here, too, is that from a positioning perspective, investors have been positioned very short rates. This trade has really done very well in recent months. And when we get this shift in momentum similar to what we're seeing today, investors who've done well on those trades are probably going to do profit taking and kind of cover those short positions here.
Meghan, how does your call on the 10-year Treasury yield factor in your assumptions about the Federal Reserve? Is essentially what you're saying that the Fed is not going to be as aggressive as the market thinks it will be?
So it's not necessarily a call on the Fed's aggressiveness relative to the market. It's really mostly this view that longer-term rates, which should be more anchored based off of those longer-term inflation expectations and growth, are really quite dislocated. You know, the Fed has a very tricky job right now. They kind of want to tap on the brakes to be able to cool demand and cool inflation, while at the same time, if they press on those brakes too hard, they risk sending the economy into a recession. And we think that as the Fed really begins to tighten policy, begins to cool demand, that is going to ultimately result in the market becoming more worried and concerned about those longer-term growth concerns and drive demand for the back end of the Treasury curve.
Meghan, today looks like a day where the market maybe views things the same as you. We've seen the 10-year Treasury yield coming down, down to 2.87%, but that's still quite elevated versus where you think it should be then. What stops your call coming to pass, if you like? What gets in the way of your call becoming a mainstream view? Because at the moment, it does seem like lots of guests, apart from yesterday and today, queue up to tell us how they think the yields go higher still.
Yeah, I think that's a fair point. There are certainly risks here. One is the fact that we see longer-term inflation expectations really become meaningfully unanchored. And by unanchored, I mean really beyond the Fed's 2% target. If we see that begin to weigh into market pricing, that's something for sure that we could see drive the back end higher. The second and very important consideration here, too, is a lot to do with demand for Treasury securities in general. If we see multi-asset investors that have typically looked to Treasuries for that risk-off protection begin to lose more faith in the back end of the Treasury curve for serving as that tool, that ultimately could really shift the demand discussion as well and cause the back end to cheapen also.
Okay, Meghan, so obviously we've been talking about nominal yields here. Can we talk about real yields as well?
Yes.
Tips? Positive, very briefly earlier today, but positive nonetheless for the first time since 2020.
Indeed.
I mean, how does your view translate over into real rates?
So we actually have 0% as our target 10-year rate for the end of the year. We really don't think that from an economic fundamental perspective, we can see longer tenor real rates really push far beyond, say maybe a 0 to 50 basis point or so range, which is consistent with where longer-term potential growth expectations for the U.S. are. If you see real rates really drive further above that level, that becomes, you know, a very important trigger for the economy in terms of contributing to that slowdown pressure. So you ultimately have this feedback loop currently in the range of where we see real rates really just at that zero level. Where you have higher rates, particularly higher real rates, kind of driving that flight to quality flow in terms of longer term economic concerns as well.
Okay, well, we'll watch to see if zero is where we stay. It seems a long way to the end of the year, of course, Meghan. We'll talk to you before then. You mentioned the growth slowdown in the US getting a lot of airtime, also recession fears getting a lot of airtime. Which
Absolutely.
of those should we be talking about then? I mean, what percentage chance do you put on a recession in the US, or is growth slowdown just as bad as it gets?
So, we probably will see the economy slow down as the Fed raises rates. This is ultimately what they're trying to achieve here. This is a very different cycle than what we saw back in 2015. When the Fed was really raising rates while inflation really wasn't much of a problem. The Fed is purposefully trying to raise rates to cool the economy, to tighten financial conditions here, to cool demand. And our economists do have growth kind of falling below longer-term trend by the end of 2023, which is when we think that the Fed will be able to hit basically the peak terminal rate that they'll be at this cycle.